Right now, something unusual is happening in the silver market. And if you're not paying attention, you might completely miss what could be one of the most important setups of 2026. Silver is not crashing, it's not rallying. It's simply sitting there, hovering around $72 per ounce, barely moving, almost as if the market is waiting, watching, holding its breath. And the timing of this stillness is what makes it even more concerning. Because as of April 7th, 2026, global markets are heading into a critical window where multiple macroeconomic and geopolitical forces are aligning at the same time. Yet silver is showing almost no reaction. That kind of behavior doesn't usually happen by accident. It usually means something deeper is unfolding beneath the surface. As of today, silver is trading close to $72, with only a narrow intraday range, even though just weeks ago it was trading significantly higher. And earlier this year, it even experienced extreme volatility after reaching triple-digit levels before correcting sharply. What we're seeing now is not a normal trending market. It looks more like compression, and historically, compression phases like this don't last very long. They tend to resolve suddenly, often catching the majority of market participants off guard. Now here's where things start to become more complex. Silver is not just another commodity. It sits at the intersection of two very different worlds. On one side, it behaves like an industrial metal heavily influenced by global demand from sectors like solar energy, electronics, and artificial intelligence infrastructure. On the other side, it also behaves like a monetary asset, reacting to inflation expectations, interest rate decisions, and global financial uncertainty. And right now, both sides of that equation are active at the same time. Inflation pressures globally have not fully disappeared. Central banks, especially the Federal Reserve, are still navigating a delicate balance between controlling inflation and supporting economic growth. Policymakers have been cautious, signaling that interest rates may remain higher for longer than markets initially expected, which typically strengthens the US dollar and puts pressure on non-yielding assets like silver. But at the same time, geopolitical tensions are rising, and historically, that kind of uncertainty tends to support precious metals. So you have two opposing forces acting on silver at once: higher interest rates, which could push it lower, and rising global risk, which could push it higher. Instead of choosing a direction, silver is doing something else entirely. It's staying flat. That's not something you can ignore. If we look at the broader picture, the behavior becomes even more interesting. In 2025, silver delivered one of its strongest performances in decades, rising over 140% in a single year, driven by a combination of industrial demand, supply constraints, and investor positioning. That kind of move doesn't just disappear. It leaves behind structural pressure in the market. It changes how institutions position themselves. It alters expectations. And yet, in 2026, the market has shifted from momentum to hesitation. We've seen sharp rallies followed by equally sharp corrections. We've seen spikes that don't hold and drops that don't continue. That kind of behavior is often associated with transitions, not endings. It suggests the market is trying to find a new equilibrium, a new balance between competing forces like inflation, liquidity, and global demand. Now think about liquidity for a moment. Liquidity is essentially the fuel of financial markets. When liquidity is abundant, prices tend to rise more easily. When liquidity tightens, volatility increases, and markets can behave unpredictably. Global institutions, including organizations like the International Monetary Fund, have repeatedly highlighted concerns around tightening financial conditions, rising debt levels, and the potential for increased volatility in global markets. These are not small signals. These are systemic indicators, and silver sits right in the middle of this system. It reacts not just to one factor, but to the interaction of many: inflation expectations, central bank policy, currency strength, industrial demand, and geopolitical developments all feed into its price. That's why when silver stops moving in an environment where all these forces are active, it raises questions. Because normally, in a situation like this, you would expect movement. You would expect volatility. You would expect a breakout or a breakdown. But what we are seeing instead is stability, or at least the appearance of stability. And that's where the real question begins. Is this actually stability, or is it something else? Because historically, markets don't stay quiet when uncertainty is high. They either react immediately, or they delay their reaction until a specific trigger appears. And right now, there are multiple potential triggers on the horizon. Geopolitical developments, particularly in the Middle East, are creating uncertainty around energy supply, which could influence inflation expectations globally. At the same time, upcoming economic data, including inflation reports and central bank communications, could shift expectations around interest rates. So what we are looking at is not just a quiet market. It's a market that may be waiting for confirmation, waiting for clarity, waiting for a signal strong enough to push it out of this narrow range. And that brings us to the current level around $72. This is not just a random number. Technically, this range has acted as a key support and equilibrium zone for silver, a level where buyers and sellers tend to find balance. When prices approach this area, decisions are made. Either the market finds support and moves higher, or it breaks below and enters a different phase entirely. So the fact that silver is holding this level right now, despite all the pressure and uncertainty around it, is significant. It suggests that there is still demand at these levels, or at least a reluctance to push prices lower without additional confirmation. But here's where things become even more important. Because when markets hold a level like this for an extended period, especially during times of uncertainty, it often means that large participants are active. Institutions don't move markets in obvious ways. They don't chase prices. They build positions gradually. They accumulate during periods of low volatility. And sometimes, the quietest markets are the ones with the most activity happening behind the scenes. This doesn't necessarily mean something extreme is guaranteed to happen. Markets are complex, and outcomes are never certain. But it does suggest that the current behavior of silver is not random. It is part of a broader setup, influenced by macroeconomic forces, institutional positioning, and global uncertainty. And that's why this moment matters. Because what we are seeing right now could be the transition point, not the final move, but the setup before it. The phase where the market pauses, consolidates, and prepares for the next direction. The question is not whether silver will move. The question is when, and more importantly, in which direction. Now here's where the situation starts to escalate, because what looks like a quiet market on the surface may actually be the result of multiple forces colliding at the same time. And each one of those forces has the potential to move silver very quickly once a trigger appears. As of April 7th, 2026, silver is trading around $72, holding within an unusually tight range between roughly $71.7 and $73.5. And that narrow movement is happening even as volatility across global markets remains elevated, which is not something you typically see unless traders are waiting for a specific event. And right now, there is a very specific event. A geopolitical deadline tied to Iran is approaching, and markets across commodities, currencies, and equities are all reacting with caution. Reports indicate that the deadline involving the reopening of a critical oil route is hours away, and any escalation could disrupt global energy supply chains. Now think about what that means. Energy supply disruptions don't just affect oil. They affect inflation, they affect transportation costs, they ripple through supply chains, and ultimately they influence central bank decisions. And that's where things begin to connect. Because central banks, especially the Federal Reserve, are already in a difficult position. Inflation has not fully stabilized, and at the same time, economic growth is showing mixed signals. If oil prices rise further due to geopolitical tension, that could push inflation higher again, limiting the ability of central banks to reduce interest rates. And historically, when interest rates remain elevated, precious metals like silver tend to face pressure because they do not generate yield. So now you have a situation where geopolitical tension is rising, which should support silver, but at the same time, the resulting inflation pressure could keep interest rates high, which may limit silver's upside. Two forces, opposite directions, and silver is sitting right in the middle, flat. But this is where it gets even more interesting, because the market isn't just reacting to current events, it's reacting to expectations, and expectations are shifting fast. In recent sessions, both gold and silver have shown signs of weakness despite rising geopolitical tension, which suggests that investors are becoming more focused on interest rates and currency strength rather than purely safe haven demand. That shift matters, because it tells you what the market is prioritizing. Right now, the US dollar remains relatively strong. Bond yields are elevated, and liquidity conditions are tighter than they were just a year ago. And when liquidity tightens, markets behave differently. Moves become sharper, reactions become delayed, and sometimes prices stop moving entirely before a major shift. Let's visualize this for a moment. Imagine the market as a pressure system. Every factor adds pressure. Geopolitics adds pressure. Inflation adds pressure. Central bank policy adds pressure. And liquidity controls how that pressure is released. Right now, pressure is building, but it's not being released. And that's exactly what makes this moment critical. Because historically, when multiple macro forces align like this, markets do not stay stable for long. They either break upward or downward, often very quickly, once clarity emerges. And if we zoom out even further, the bigger picture becomes even more compelling. Silver is still up significantly over the past year despite recent declines. In fact, over a 12-month period, silver has gained more than 140%, even after the recent pullback. That tells you something important. The long-term trend has not completely disappeared, but the short-term behavior has changed. And when long-term strength meets short-term uncertainty, you get consolidation, you get hesitation, you get exactly what we're seeing right now. But consolidation phases don't last forever. They resolve. Now here's something most people don't realize. Markets often move the most, right after they stop moving. Because during these quiet phases, large participants may be adjusting their positions. Institutional investors don't chase headlines. They position ahead of them. They analyze liquidity. They monitor risk. They prepare. And sometimes, the absence of movement is not a sign of calm. It's a sign of preparation. Don't ignore this. Because right now, silver is sitting at a level that has historically acted as a decision point. Around $70 to $72 has been identified as a key support zone where buyers tend to step in and prevent further declines, at least temporarily. And the fact that silver is holding this level, despite all the pressure around it, is significant. It suggests that there is still underlying demand, or at least a reluctance to push prices lower without confirmation. But confirmation is coming, because this weekend, and heading into Monday, markets are expected to react to multiple developments at once. Geopolitical outcomes, economic data, central bank expectations, and when multiple triggers hit at the same time, markets don't move slowly, they move fast. And silver right now is positioned exactly at the point where that move could begin. Not confirmed, not guaranteed, but possible. And that's the key. This is not about certainty, it's about probability. Because historically, when volatility compresses and macro pressure builds, the probability of a sharp move increases. And that's exactly the setup we are seeing right now. Now this is where things move beyond just silver and start pointing towards something much bigger, something deeper inside the financial system itself. Because if you step back and look at what's happening globally right now, silver is not the only asset behaving strangely. Precious metals overall have been showing signs of instability, even in conditions where they would normally thrive. And that tells you something important. This may not just be about supply and demand. It may be about the structure of the system itself. Over the past few months, both gold and silver have experienced extreme volatility. Silver alone dropped more than 30% in just a matter of days earlier this year after reaching highs above $120. And that kind of move was not purely driven by fundamentals like industrial demand or mining supply. Analysts pointed out that liquidity conditions, margin pressures, and speculative positioning played a major role in that collapse. Think about that for a second. Not fundamentals, liquidity. Because in modern financial markets, liquidity often matters more than logic. When liquidity is strong, markets can absorb shocks, prices move gradually, trends feel stable. But when liquidity tightens, everything changes. Movements become sharper, reactions become faster. And sometimes assets drop, not because they should, but because they have to. We saw exactly that earlier this year when a massive sell-off wiped out trillions across gold and silver markets, driven largely by margin calls, forced liquidations, rather than a sudden change in economic reality. That's how fragile the system can become under pressure. And now, that same pressure may be building again. Global institutions are already warning about it. The International Monetary Fund recently highlighted that evolving financial systems, especially with new trading technologies and interconnected markets, could amplify financial stress events and accelerate market reactions beyond traditional control mechanisms. In simple terms, when something breaks, it may break faster than expected. Now, connect that back to silver. Silver is not just reacting to inflation or industrial demand anymore. It's reacting to the structure of the market itself, a market where liquidity conditions, institutional positioning, and macro uncertainty all interact at the same time. And right now, all three are active. Let's break this down. First, inflation. Inflation has not fully stabilized globally. Energy prices remain sensitive to geopolitical developments, especially with tensions around key oil routes. And as we've seen in recent reports, any escalation could push oil prices higher, which would feed directly into inflation. And when inflation rises, central banks, especially the Federal Reserve, may be forced to keep interest rates higher for longer. Second, interest rates. Higher interest rates strengthen the dollar and increase the opportunity cost of holding assets like silver, which do not generate yield. This creates downward pressure, even in environments where demand should be strong. We've already seen this dynamic play out multiple times this year, where strong economic data and a firm dollar weighed on silver prices despite ongoing global uncertainty. Third, liquidity. Liquidity is tightening, and when liquidity tightens, markets don't behave rationally, they behave mechanically. This is where most people misunderstand what's happening. They look at silver and think, it's not moving, so nothing is happening. But in reality, everything might be happening beneath the surface, because during low volatility phases, large institutions may be repositioning, not all at once, not visibly, but gradually. And that's exactly the kind of environment we're in right now. Let's go even deeper. Silver demand itself hasn't disappeared. In fact, global demand is expected to remain relatively strong in 2026, supported by continued investment interest and industrial usage, even though some sectors like jewelry may slow down due to high prices. And at the same time, the market is still dealing with a structural supply deficit, meaning demand continues to outpace supply over multiple years. Now think about that. A market with strong demand, limited supply, and rising global uncertainty should not be flat. So again, the question comes back, why is silver not moving? And this is where psychology enters the picture. Markets are not just driven by data, they are driven by expectations, by positioning, by fear. Right now, investors are caught between two narratives. On one side, the traditional view that silver should benefit from uncertainty, inflation, and structural demand. On the other side, the reality that higher interest rates, a strong dollar, and tighter liquidity may suppress prices in the short term. and when markets are caught between two conflicting narratives. They pause, they hesitate, they compress. Exactly like we're seeing now. But here's the critical part. This kind of hesitation doesn't last forever, because eventually, one narrative wins. And when it does, the move is usually fast, sharp, and often unexpected. Now bring this back to the current moment. Silver is sitting at around $72, holding a key support level, not breaking down, not breaking out. At the same time, global tension is rising, inflation risks remain, central banks are uncertain, liquidity is tightening, and a geopolitical deadline is approaching. This is not a normal setup. This is a convergence, multiple forces, all aligning at once. And historically, when markets reach this kind of convergence point, they don't stay quiet, they move. The only question is, in which direction? And more importantly, how fast? Because if liquidity conditions tighten further, and if a trigger event hits at the same time, the move in silver may not be gradual. It may be sudden, not guaranteed, not certain, but possible. And that possibility is exactly what the market is waiting for right now. Now, this is the part where everything comes together, because what we're seeing right now is not just a price level, it's a moment where multiple forces are converging at the same time. Silver is sitting near $72, not moving, not reacting, just holding. And under normal conditions, that might not seem unusual. Markets consolidate, prices pause. That's part of the cycle. But these are not normal conditions. Right now, global markets are dealing with a combination of factors that rarely align so closely. Inflation remains uncertain. Central banks are still navigating policy decisions. Liquidity conditions are tighter than they were just a year ago. And geopolitical risks continue to evolve in real time. And yet, silver is still flat. That's where the real tension comes in. Because when markets remain stable during unstable conditions, it usually means one of two things. Either the market is confident about the outcome, or it's waiting for confirmation before reacting. And historically, that second scenario tends to be more common. Let's slow this down for a second, because this is important. Markets don't always react immediately to major events. Sometimes they wait until uncertainty is resolved. They wait for clarity, they wait for data, for decisions, for outcomes that remove doubt. And right now, we are approaching one of those moments. A moment where several key developments could unfold within a very short period of time. Economic data releases, central bank signals, and geopolitical updates that may influence global energy markets. Now think about how interconnected all of this is. If energy prices rise due to geopolitical tension, inflation could increase. If inflation increases, central banks like the Federal Reserve may be forced to keep interest rates higher for longer. If interest rates stay high, that could strengthen the dollar and create pressure on assets like silver. But at the same time, if uncertainty rises significantly, investors may still move toward precious metals as a hedge. So again, two forces, opposite directions, and silver is sitting right in between them. This is not a clear trend. This is a balance, a temporary balance. But balances don't last forever. At some point, something shifts, and when it does, the market moves. Now here's where timing becomes critical, because we are heading into a period where multiple catalysts could appear almost simultaneously. This weekend, and going into Monday. And historically, when markets enter a weekend with unresolved tension, the opening that follows can be unpredictable, not always dramatic, not always extreme, but often decisive. And silver is positioned right at a level where that decision could become visible, around $72, a level that has acted as support, a level where buyers have stepped in before, a level that is held for now. But the question is, will it continue to hold? Because if that level breaks, it may signal a shift in sentiment, a shift in positioning, a shift in how the market is interpreting the current environment. And if it holds, that may indicate something else entirely, that buyers are still active, that demand is still present, that the market is not ready to move lower. Either way, a decision is approaching. Now let's bring this back to what matters most. This is not about predicting a specific price. It's not about saying silver will go up or down tomorrow. Markets don't work like that. There are too many variables, too many unknowns. But what we can observe is the setup. It tends to move quickly, not guaranteed, not certain, but possible. And that possibility is what makes this moment important, because most people will only react after the move has already started, after the breakout, after the breakdown, after the headlines. But by then, the opportunity may already be gone. That's how markets work. They reward preparation, not reaction. So the real question is not, what is silver doing right now? The real question is, what is silver preparing to do next? And that answer is not fully visible yet, but the setup is already in place. And as we move into this weekend and closer to Monday, the probability of that setup resolving may increase. So watch this level, watch the reaction, watch how the market responds when new information comes in, because the next move may not come with a warning. It may already be starting before most people even notice. And right now, silver is still sitting there at 72, waiting, or maybe preparing. And the only thing left to ask is, when the move finally begins, will you see it in time? Now here's what I want you to do. If you're watching this, it means you're already ahead of most people, because most people won't even notice this until the move has already happened. So don't just watch this and forget it. Watch what happens next. Watch the reaction. Watch the level. Watch how the market behaves going into this weekend, and especially before Monday. And if you're serious about understanding moves like this, make sure you stay connected, because when this breaks, I'll be covering it in real time. So hit subscribe, not just for updates, but so you don't miss the moment when this setup finally resolves. Because as we've seen, timing matters. And in markets like this, being late is the same as being wrong. Also, I want to hear from you. Do you think silver breaks above this level, or do we see a deeper move lower? Drop your view in the comments. The biggest opportunities are hidden in the quietest moments. And right now, silver is still quiet, but not for long.